There's a silent rule in trading that almost nobody talks about. A rule so simple, yet so profoundly misunderstood that it separates those who survive from those who are swallowed whole. You won't find it in textbooks or in the strategies shared on YouTube. It's not about entries, exits, or indicators. It's something much deeper, a structural law that governs how the market moves, how traders behave, and how capital flows from the impatient to the patient. For 15 years, I've watched this same cycle repeat. Retail traders obsessing over signals, while institutions quietly position themselves against the noise. It's a perfect illusion, a zero-sum theater where confidence is manufactured and fear is engineered. The rule I'm talking about isn't a tactic, it's a truth. The market doesn't reward knowledge, it rewards discipline. The market doesn't move on information, it moves on liquidity. The market doesn't punish the weak, it consumes the predictable. Every blown account I've seen, every trader who vanished after one bad week, fell victim to this same misunderstanding. They thought trading was about being right. It isn't. Trading is about surviving long enough for probability to work in your favor. What's ironic is that this rule hides in plain sight. It's visible in the way price reacts at liquidity zones, in the false breakouts that trap emotional traders, and in the perfect precision of stop hunts that seem too accurate to be random. Today, I want to strip away the layers of myth and ego to reveal how this law actually operates beneath every chart, every time frame, every market. Because until you understand this rule, you'll always be playing someone else's game. And once you see it clearly, you'll never look at price action the same way again.
I still remember the first year I traded. The chaos, the obsession, the illusion of control. I thought trading was a game of intelligence. I devoured books on technical analysis, memorized candlestick patterns, watched hours of chart breakdowns on YouTube. I believed that if I just learned enough, I'd find the secret formula that institutions use to win. But the market doesn't bend to intellect, it bends to liquidity. And that lesson didn't come through reading, it came through pain. I blew my first 3 accounts in less than a year. Each time I told myself I'd learned the lesson, that I'd fixed my mistakes. But every time I'd fall into the same trap, chasing moves that had already happened, entering trades because I didn't want to miss out. I wasn't trading price, I was trading emotion, disguised as logic. There's a strange phase every trader goes through, a kind of delusion where you think you understand the market, but in truth, you're only understanding yourself under pressure. The charts become a mirror, and what you see reflected there isn't price, it's your own fear, greed, and need for certainty. The turning point came during a single trade, Euro-USD, summer of 2011. The pair was consolidating before a major ECB announcement. I had my analysis ready, convinced that a breakout was coming. When the price spiked up, I jumped in with heavy leverage, and within minutes it reversed sharply. My stop loss was hit so fast I didn't even process what happened. But when I looked deeper, something clicked. That move wasn't random. The market had hunted the liquidity sitting above a clean structure. Traders like me, waiting for a breakout. It was deliberate. Institutional traders weren't chasing direction. They were chasing liquidity. That's when I realized I wasn't losing because I was wrong about direction. I was losing because I was predictable. That realization changed everything. It marked the beginning of a new phase, one where I stopped trying to beat the market and started trying to understand it.
There's one rule that governs every market, whether it's Forex, stocks, crypto, or commodities. It's not trend is your friend. It's not cut losses quickly. It's this: the market exists to seek liquidity, always. Every move you see, every fake breakout, every sudden reversal, every parabolic rally is not a random fluctuation. It's a calculated process of transferring wealth from the impatient to the patient, from the uninformed to the informed. When you understand liquidity, you stop asking, why did price do that? And start asking, who was trapped there? The market moves where the orders are. Think of it like a river. Liquidity pools are the deeper spots, and price naturally flows toward them. The stop losses retail traders place? That's the water. The big institutions, the so-called smart money, are the engineers who redirect the current to collect that liquidity before moving price in the intended direction. It's the law beneath all indicators. Support and resistance, Fibonacci levels, moving averages, they all work sometimes because they coincide with liquidity zones. But they fail when the liquidity shifts elsewhere. That's why no static system survives time. Only understanding structure and flow does. Once I grasped this, I began to see the market like a chessboard. Every move had intent. When price formed a clean high or low, I didn't see breakout potential. I saw a trap being set. When the market consolidated, I didn't see indecision. I saw accumulation before manipulation. This is the supreme rule. Liquidity drives direction. Not news, not indicators, not opinions. Every major move begins as a hunt for liquidity and ends where liquidity is consumed. It sounds simple, but this is where 99% of traders fail. They try to trade patterns. They try to predict. But prediction is an illusion. The pros don't predict, they position. They understand where the liquidity lies, and they wait. Trading isn't about being right. It's about aligning yourself with the invisible architecture of liquidity that governs all price action.
Once you accept that liquidity is the core law, the next question becomes, how does it actually control price? To see that, you have to zoom in, not on the chart, but on the behavior of participants. Every candle you see is a record of two opposing intentions, fear and greed. But beneath those emotions are orders, buy stops, sell stops, pending entries, stop losses, take profits, all forms of liquidity waiting to be triggered. Now imagine the market as a living entity feeding on this liquidity. Price doesn't just move, it's pulled toward pools of orders because that's where transactions can occur. Large players, institutions, market makers, algorithmic systems need liquidity to fill their massive positions. But they can't simply buy or sell millions of units at one price. They must engineer liquidity. That's why you'll often see what looks like a breakout, a clean surge above resistance, only for price to reverse violently. Retail traders enter long positions, thinking the breakout is confirmed, while the big players use that rush of orders as fuel to fill their sell positions. This is liquidity engineering. Similarly, when markets form obvious lows, the crowd expects a breakdown. Short orders cluster below those lows, stop losses from longs, pending sells from breakout traders. What happens next? A sharp wick pierces those lows, grabs all that liquidity, and price snaps back up. To the untrained eye, it's noise. To the professional, it's the collection phase before the real move. It's the same mechanism, over and over again, across every time frame. Liquidity pools attract price. Price sweeps them, institutions fill orders, price moves away in the true direction. That's why if you trace any major market reversal, you'll find it starts with a liquidity grab. The market isn't random, it's engineered equilibrium,
an ongoing process of filling large positions without revealing true intent. And the tragedy is this: retail traders supply that liquidity through their impatience and predictability. So to truly see the market, you have to train your eyes not to look at price, but through it. Ask yourself, who's getting trapped here? Whose orders are being targeted? Who's accumulating quietly while the public reacts emotionally? When you can answer those questions, you stop chasing moves. You start reading intent. That's the hidden mechanism. That's how the market feeds.
Every trader begins with the same dream: to master the market through skill, discipline, or perhaps the right system. But the truth is more brutal. Most traders are not even playing the same game as the professionals. They are participants in a carefully designed illusion: the illusion of control. Retail traders think in terms of entries, indicators, and confirmation. They spend years optimizing parameters, backtesting strategies, or waiting for a perfect setup. But the market doesn't reward certainty. It rewards asymmetry. Institutions are not trying to predict where price will go. They are identifying where liquidity currently exists and using it to create movement. While retail traders wait for confirmation, professionals are the ones creating it. For example, a retail trader sees a clean bullish breakout, volume spikes, and momentum indicators turn green. It looks safe, logical, confirmed. So they enter. But what they don't realize is that this confirmation is often engineered, a brief liquidity expansion designed to pull in reactive traders before reversing. By the time they enter, the move is already over. This cycle repeats endlessly. 1. Market builds a structure. 2. Crowd recognizes it. 3. Big players use that recognition to trap them. 4. The move reverses. 5. Retail blames emotion, lack of patience, or risk management, never realizing they were supposed to lose. It's not incompetence, it's structural. The system depends on the crowd to provide the opposite side of institutional trades. If everyone traded like a professional, the market couldn't function because there would be no liquidity to fuel the moves. This is the cruel paradox of trading. The more you think you're in control, the more predictable you become. The more predictable you are, the easier you are to exploit. That's why 99% of traders fail, not because they lack intelligence, but because they've been conditioned to believe in a false sense of control. They react to what they see instead of perceiving what's being shown to them. They chase price, but price is always one step ahead because it's being guided by those who understand the rules beneath the illusion. To escape this trap, the trader must stop trying to control outcomes and start interpreting behavior. Only when you surrender the illusion of control do you begin to understand how the market truly moves.
There comes a moment in every serious trader's journey, the quiet, almost sacred moment when the illusion finally shatters. You begin to see the market not as a chaotic battlefield of random price action, but as a living ecosystem of intent, deception, and liquidity. It's the awakening, the shift from price to purpose. When I first grasped this, it wasn't through theory. It was through pain. After years of losing, of being consistently almost right, I began to study the footprints instead of the candles, to ask not what price was doing, but why. That's when I discovered the deeper framework that institutions follow, not indicators, but liquidity engineering. Every spike, every fake breakout, every stop hunt wasn't random, it was calculated.
a process designed to accumulate orders where traders least expected, and then drive price in the path of least resistance, the direction where liquidity is thinnest. The structure became visible. The equal highs that look like clean breakouts, they're liquidity magnets. The stop hunts that seem like accidents, they're entry mechanisms. The range consolidations that frustrate traders, they're reaccumulation phases. The market wasn't chaotic, it was strategic. And once you see that, you can never unsee it. I began to stop chasing confirmation. Instead, I started watching intent. Who is trapped? Who needs to exit? Where is liquidity likely sitting right now? When you think like that, your relationship with the market changes forever. You stop reacting. You start reading. You stop fearing volatility. You embrace it because it tells you where the next imbalance will occur. This awakening is not glamorous. It doesn't come from a winning streak or a lucky setup. It comes from disillusionment, from realizing how wrong you've been and how much you've misunderstood. But once that realization settles in, you become something different. You stop being a trader who fights the market. You become a participant who moves with it. You no longer ask, is this bullish or bearish? You ask, who's being manipulated and why now? That single shift in perspective transforms everything. Your patience, your execution, your confidence, your outcomes. It's the true beginning of mastery, the moment when the market finally stops being your enemy and starts being your teacher.
Every professional trader, whether on a prop desk or in an institutional flow team, operates on a single unspoken law. The market moves toward liquidity and away from it. That's the core principle, the DNA of price movement. Retail traders chase direction. Professionals chase liquidity. And once you understand that distinction, the fog begins to clear. Liquidity is simply the pool of pending orders, stop losses, limit entries, pending buy or sell orders that accumulate at obvious levels. The market is not searching for fair value. It's searching for fuel. That fuel lies where the crowd hides their stops. When you see a breakout above resistance that suddenly collapses, that's not manipulation for its own sake. It's distribution. When price dips sharply below support only to reverse instantly, that's not noise. It's accumulation. Smart money logic is built on this premise. The market's purpose is to fill large institutional orders without revealing intent. To do that, it needs counterparties, liquidity, which it finds by inducing retail traders into emotional reactions. So the cycle repeats. 1. Create expectation. Form a clear trend or structure to anchor trader bias. 2. Induce participation. Trigger retail traders to take positions based on that bias. 3. Reverse into liquidity. Use their stops as entry liquidity for institutional orders. 4. Deliver the true move. Once filled, drive price efficiently toward the next liquidity pool. This cycle is constant, fractal, and self-sustaining. It happens on the 1-minute chart and the monthly chart alike. Understanding this doesn't just change how you trade, it changes how you think. You no longer measure trades in pips or points, but in context. You stop asking, is this support holding, and start asking, whose orders are exposed here? This is why most retail traders lose. They're fighting the structure without ever realizing it's a game of order flow engineering. Indicators lag because they measure reaction, not intent. Smart money operates on intentions, anticipating where liquidity will be needed next, not where it was last visible. When you internalize this, trading becomes less about prediction and more about interpretation.
You don't need to know the future. You just need to read the story the market is already telling. The same story that's always been there, hidden behind every candle. This principle, liquidity drives price, is the thread that connects every chart, every market, every time frame. Ignore it, and you'll forever trade in the dark. Understand it, and you'll finally see how the machine really moves.
Once you grasp that liquidity is the engine of all market movement, the next question becomes, how do you build a system that aligns with that reality instead of fighting it? Most retail traders build their strategies backwards. They start with indicators, entry signals, and profit targets. Smart traders start with structure and intent. Let's break this framework down into its essential layers. 1. Market structure, the map. Before you can trade, you need to see where the liquidity lives. Structure gives you that map. Instead of labeling everything as support and resistance, you identify where liquidity has already been taken, mitigated zones. Where liquidity is still resting, equal highs or lows, untested zones. And where major inefficiencies remain, imbalances, fair value gaps. This isn't guesswork. It's observing how price moves to rebalance inefficiency and collect liquidity, always oscillating between overextension and reversion. 2. Time frame alignment, the lens. Institutional flow is multi-temporal. Liquidity exists on all time frames, but execution happens where risk is smallest. So your structure should cascade like this. Higher time frame, HTF, determine liquidity direction, where's the next pool. Mid-time frame, identify the specific structure, internal range, displacement, or retracement. Lower time frame, wait for confirmation, a break of structure, or change of character, a CHOCH. The confluence between these time frames is what transforms probability into precision. 3. Entry logic, the trigger. Entries aren't about prediction, they're about reaction at the right place. In liquidity-based trading, entries often happen after manipulation. You wait for the stop hunt, the displacement, the imbalance, and then you strike when the market confirms intent. The key idea: the best trades are entered after retail traders are stopped out. Your edge isn't speed, it's patience. 4. Risk and execution, the discipline. Smart money doesn't aim for a high win rate. It aims for asymmetrical returns. You risk 1R to potentially make 4R or 6R. That's why precise entries near liquidity give such leverage. You're buying value at discount or selling premium. This means risk management isn't a backup plan, it's the plan itself. If you control risk and trade where liquidity provides context, the math eventually tilts in your favor. 5. Psychological reinforcement, the mindset. Even with perfect structure, traders fail because they don't internalize the why. You must shift your mental model from "I'm predicting price" to "I'm reading liquidity behavior." Once you do, emotions like FOMO and revenge trading naturally subside because you realize the market must engineer emotion to generate liquidity. Every fake out, every sudden move is the market doing its job, not an attack on you. That understanding separates amateurs from professionals. This framework isn't about following a guru or memorizing setups. It's about understanding the machinery that drives all setups. You're no longer trading patterns, you're trading purpose. And when your strategy aligns with the market's purpose, consistency stops being a dream and becomes an outcome of design.
Here's the cruel irony. Even after learning everything about liquidity, structure, and smart money concepts, most traders still lose. Not because the framework doesn't work, but because they don't. Let me explain the paradox that traps 99% of people even those who know exactly how the market functions. 1. Knowing versus internalizing. Knowledge is easy. You can watch 100 videos, read every ICT note, and memorize every liquidity term. But if your nervous system still reacts to loss with fear or revenge, you're not trading knowledge, you're trading emotion. Real mastery happens when knowledge moves from the head into the hands, when execution becomes boring, repetitive, disciplined. And boring is where money grows. 2. Understanding the concept doesn't mean living the concept. Many traders understand liquidity. They can explain it fluently. But when price sweeps liquidity, they still chase entries because the mind can't resist being right. The ego wants to outsmart the market, not flow with it. True understanding means you're no longer surprised by manipulation. You expect it, you wait for it, and you capitalize on it. That requires humility, the kind you only earn through loss. 3. The discipline gap. Markets don't reward intelligence, they reward consistency. Most traders quit right before their system matures because they can't endure the monotony of disciplined execution. They jump systems, tweak entries, change risk parameters, all because patience feels like pain. But trading is like weightlifting. Results don't come from intensity, they come from repetition under control. 4. The psychological debt. Every trader starts with a hidden debt, emotional baggage from loss, overconfidence, and illusion of control. If you don't pay that debt consciously through journaling, reflection, and risk limits, the market will collect it for you with interest. The paradox is this: the more you try to control the market, the less control you actually have. The moment you surrender control, focus only on process, that's when consistency begins. 5. The final barrier: belief. Trading isn't just technical, it's existential. You're battling your beliefs about money, effort, and self-worth every time you click buy or sell. Most traders unconsciously sabotage themselves because winning challenges their identity. They're addicted to struggle. It's familiar. To win consistently, you have to outgrow not just bad habits, but an old version of yourself. That's why trading is ultimately a mirror, and liquidity is just the reflection of human psychology in motion. The paradox is painful, but it's also liberating, because once you accept that the market is not the enemy, that it's simply exposing what's unresolved within you, every loss becomes data, and every win becomes feedback. That's when trading stops being chaos and becomes clarity.
After 15 years of trading, blowing accounts, studying institutions, and mentoring others, I've realized there's only one rule that truly matters. Everything else, the charts, indicators, entries, is noise compared to this. Trade only when you understand who is trapped and why. That's the ultimate rule, because the market is not a battle between buyers and sellers. It's a battle between trapped liquidity and informed capital. 1. Every candle has an intention. Each candle you see is not random movement, it's the residue of intent. Someone was trapped there, a stop hit, a liquidation triggered, a bias reinforced. When you start reading candles as footprints of manipulation, you stop reacting and start anticipating. That shift from reaction to interpretation is what separates the professional trader from the emotional one. 2. Trading from awareness, not impulse. The rule forces you to slow down. You stop entering trades because a pattern looks good and instead ask, Who just got stopped out here? What liquidity has the market just collected? Who will provide the fuel for the next move? When you think in liquidity flows, you're no longer a participant in the crowd, you're the observer of the crowd. That mental distance is your edge. 3. Process becomes the goal. Most traders chase profits. Smart traders chase process. When you obey this rule, your metrics change. You track quality of decisions, not quantity of trades. You measure emotional neutrality, not daily returns. You focus on execution alignment, not market direction. Paradoxically, when you stop chasing profit, profit begins to chase you. 4. The market as a teacher. Every trap, every fake breakout, every stop hunt is the market teaching you to see deeper. The rule doesn't promise that you'll stop losing. It promises that every loss will have meaning, a message, a lesson, a refinement of your perception. That's the real mastery, when you stop being a victim of volatility and start using it as your feedback loop. 5. The transformation. When you finally internalize this rule, something shifts permanently. You stop identifying as a trader and start identifying as a student of behavior. You no longer fear drawdowns because they no longer define you. And in that quiet confidence, trading becomes less about chasing money and more about pursuing truth. The truth about markets, the truth about human psychology, and the truth about yourself. So, the ultimate rule is not a strategy, not an indicator, not a pattern. It's a way of seeing. Seeing liquidity, seeing traps, seeing emotion, and staying still while everyone else reacts. That's what makes you not just a survivor, but a professional. Because in the end, trading is never about predicting the next move. It's about understanding the game well enough to stop playing it emotionally. And when you do, you realize the secret most never grasp. The market doesn't reward those who fight it. It rewards those who understand its rhythm and align.